as you have already learned, I like to set up these problems using the expanded accounting equation, and I put down the beginning numbers given, the ending numbers given, and then the changes. I put in all the known information, and then I solve for the unknown. I think if you'll follow this approach, these things are a slam dunk. Let's go ahead and put in the information that's known. At the beginning of the year, X1, assets were 90, capital stock was 10, and retained earnings was 40. So the missing piece of information for the beginning of the year expanded accounting equation is the liabilities. During the year, the company earned $80 in net income. What that means is this change in retained earnings is partially explained by net income. All these here explain why the accounts changed from the beginning of the year to the next. So I'm going to go ahead and put in some lines so you can see that. Net income would come in here to explain increases. For capital stock, stock issuances would explain increases. Things that would cause retained earnings to go down are your dividends and any net losses incurred. If the company were to buy back its own stock, that would cause capital stock to go down. Let's put in the information that's known about net income. Net income is $80. Assets decreased by $20. Liabilities increased by $30. And new capital stock of $70 was issued. That's over here, new capital stock issuances of $70, and no stock repurchases occurred. That would be 0. Compute beginning liabilities. Well, that's actually one of our easier ones because we already have enough information to solve for the unknown. If the company has $90 in assets and $50 of that are claimed by the owners, then that must mean that $40 are claimed by the lenders and creditors. So the beginning liabilities are 40. Ending assets. If we know that our beginning is 90 and then it decreased by 20, then the ending must be 70. Compute ending capital stock. Well, we know that things that would cause capital stock to change would be stock issuances, which are 70, and there were no stock repurchases. Therefore, this must have gone up 70. The change in capital stock is an increase of 70. So if you started with 10 and you increase by 70, you are now up to 80 for your ending capital stock. Let's look at what we can do for retained earnings. We don't have enough information here yet to solve going horizontally, but we can solve for ending liabilities. We started at 40, we added 30, so that is 70. Now we have enough information that we can solve for the missing retained earnings. 70 in liabilities plus 80 in capital stock, that's 150. 150 plus something gets us all the way down to 70. That must mean this went down by 80. 150 minus 80 equals 70. If you look at this, the owners have no equity in the business. It's 0. It zeroes out. Why? Because all of these assets were totally funded by the liabilities. There's nothing left over. The owners don't own anything remaining. If we started with 40 and then it went down to 80, if you look at a number line, you are at 40 and then you're going all the way down to negative 80. That swing is a $120 negative swing. Retained earnings decreased by 120. Let's verify that that's true. If this is 100 minus 120, that means this went down by 20. That's correct. If your net income is 80, the change in retained earnings is going to be equal to your net income for the year minus your dividends. If your net income is 80, you have to deduct something to get to negative 120. In order to get to negative 120, you would actually have to deduct 200. In other words, they paid 200 in dividends. Let's verify that out. 80 minus 200, negative 120. We've already proven that this works. 100 minus 120, negative 120. That's how you solve this problem. Let's go ahead and put in the information that we now know. Compute ending capital stock and retained earnings. Ending retained earnings, negative 80. Sometimes I see students compute it correctly, but then they write down the wrong answer, so make sure you get the right answer. How much in dividends were recorded during the year? Retained earnings went down by 120. If we add the net income minus whatever the dividends are, we will get to 120. This would have to be 200 in dividends. $200 in dividends were paid during the year. We report it as a positive number, but we deduct that positive number to get down to the change in retained earnings. What was the change in retained earnings? It went down 120. I will admit this is a little unusual to have your retained earnings be negative, but it does happen. In startup companies, you often will see their retained earnings be negative. Why? Because they're not earning any money yet. They're just incurring losses as they try to get their business going. Often, if you see a negative retained earnings, which we call accumulated deficit, it's often because the company is in the startup phase of the business. Now, if it is a more mature company and this is still negative, they may be on the way out. Well, hopefully this helped you. I wish you all the best.